Over the past year, more than $600 billion of foreign money has flooded into US stocks. That's the largest inflow ever, bigger than at the peak of the dot-com hype, and even larger than 2021's stock market frenzy. That sounds like a vote of confidence, but when we overlay this chart with the stock market, we can see that massive inflow surges, like in 2001, 2007, and 2021, coincided almost perfectly with major market tops. In each case, capital rushed in after long rallies, not before them, and shortly after, markets rolled over. Now, this usually happens because of something economists call the crowding effect. Late in a bull market, strong performance feeds on itself. Strong returns attract more investors push prices higher, and higher prices pull in even more capital. But eventually, the market gets too crowded. When everyone who wants to buy is already in, there's no one left to keep the rally going. Optimism is at a record high, but fresh demand is empty. But if the market really is that crowded, we should see it in the data. This chart shows us how individual investors are allocating their portfolios, and right now, more than 70% of their assets are invested in stocks, one of the highest readings of the past decade. At the same time, cash levels have fallen to just 14%, near their lowest point in years. This means that the average investor isn't just already tapped out, there is almost no dry powder left on the sidelines to buy the next move up. But investors aren't just running down their cash, they're starting to bet with money they don't even have. Over the past 3 years, total margin debt has surged by nearly 50%, climbing to around $1.2 trillion, the highest level on record. That's usually what markets look like when investors are becoming more comfortable taking risk, and that matters when valuations are already elevated like today. The S&P 500 is currently trading around 22 times earnings, a level we last saw during the dot-com boom and again just before the 2022 bear market. This combination of stretched valuation and aggressive risk-taking puts the market in a fragile state, where it becomes more vulnerable to unexpected shocks. And that's why some of the most prominent investors like Howard Marks and Ray Dalio are starting to sound cautious as we head toward 2026. However, as Ray Dalio himself has pointed out, these signals on their own don't usually end a bull market overnight. For markets to actually turn, there typically needs to be a catalyst, and historically, these two forces matter more than anything else. The first place to look for a turning point is earnings. This chart shows US corporate profits, and as we can see, they typically drop leading into past recessions. But the interesting part is when these corporate profits peak. If we overlay this with the stock market, we can see that profits often start weakening well before stocks roll over. It happened in the late 1990s during the dot-com boom, in 2007 leading up to the global financial crisis, and ahead of the 2022 bear market. In each case, prices kept rising, but the profit engine underneath the market was already losing steam, and that is when speculation becomes dangerous. But that's not what we're seeing today. Corporate profits are still holding up, and major banks like Goldman Sachs and UBS are expecting earnings to grow at a double-digit pace over the next year. That matters, because as long as profits are growing, markets can possibly stay expensive longer than many expect, which suggests that fundamentals alone are not yet signaling a clear turning point. However, that earnings outlook hinges on one crucial factor, and that's the broader macro backdrop, especially inflation. Historically, rising inflation has almost always been bad news for corporate profits. You can see it clearly in 2000, in 2007, in 2022, and even back in the late 1980s. When inflation rises, consumers lose purchasing power and start cutting back on spending. At the same time, companies face higher input costs from wages, energy, and raw materials, and eventually, central banks are forced to tighten financial conditions. All of that squeezes profit margins. And indeed, if we overlay inflation with the stock market, a substantial rise in the inflation rate, above 3.5%, has almost always been the catalyst that ultimately pushed markets lower. But today, inflation is moving in the opposite direction. It's fallen sharply from its 2022 peak, with the latest reading around 2.7%, and many economists believe it could continue moderating into 2026. If that plays out, falling inflation remains a key tailwind supporting the market's rally. But if inflation quickly picks back up, whether driven by geopolitical shocks or renewed money creation, that's when caution becomes more important. And perhaps the record inflows we saw earlier could once again be followed by a local top in the stock market. At Capital.com, we'll continue tracking how market sentiment, fundamentals, and macro forces shape financial markets. Hit like and subscribe to stay tuned. Thanks for watching.